Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So the S&P closed around 6,000 on Friday. We are above barely that level now, but nonetheless, I mean, we're now officially in a bull market. So now our eyes turn to the trade talks in London between U.S. and China representatives, and if that's going to be enough to start moving the needle for the equity market higher. Joining us now is Brendan Murray. He is Bloomberg Global Trade Editor. What's a win for both sides?
A win for both sides is going back to the Geneva Agreement from a month ago and saying, here are the clear goalposts that we set for each other and that we're going to try to meet going forward. And then setting the stage for future rounds of talks, that they have enough in common and the tone in the room is good. Remember, these are two sides that sat together a month ago and came away and didn't really understand what they had agreed to. So here we are again. They just started the discussions a couple of hours ago here in London. It's expected to go well into the early evening, maybe even into Tuesday if they get hung up tonight. So the real goal here is to reestablish the framework for some talks. We're 2 months from the end of the 90-day reprieve that both sides agreed to when they brought their tariffs down. So time is ticking, and these are complicated talks, and they're not going to be done in just a few meetings. So the real goal here is momentum and maintaining the forward momentum.
I don't know. My strategy would be just walking down to the local pub, have a couple of pints, work this thing out. I mean, how tough can it be? Brendan, where are we on tariffs here? I can't keep track of where we are on tariffs. Could you just remind us kind of what the current status is?
Yeah, so part of that 90-day reprieve was to bring the very high tariffs down, 145% on Chinese imports into the U.S., extremely high tariffs for U.S. goods going to China. They brought those down. The U.S. is at about 30% on Chinese goods now. China brought theirs down to 10%. So those are by no means low tariffs. Those are still having an effect. They're diminishing the share of trade that's moving between the two countries. So tariffs are going to be there for a while. Those aren't the kinds of things you start taking off this early in a negotiation. Those are leverage that you take off later on down the road once you can accomplish some of the other things that you accomplish. And for the moment, the U.S. is focused on seeing those rare earth elements, those key magnets and other things that are needed to make batteries and high-tech medical equipment start flowing back to the U.S. so American companies don't have to shut down their production lines. And China wants some of the export restrictions that the U.S. put on its high-tech exports to China, some of those lifted. It seems like the two sides came into these talks willing to give up some of those. So we'll have to wait and see where it goes from here. But we're expecting that they'll come away from these discussions with some sort of basis to continue the negotiations on a whole host of other things. Tariffs, like I said, not going to be addressed today. Those are further down the road.
Who is the leverage? This is my favorite question. In a minute, who's the leverage?
Well, you could argue that both sides have leverage. Look, President Trump has said he'll take tariffs back up and he'll cut off U.S. trade with China. As he did, initially, China would say, yeah, well, we'll just starve you of rare earth elements and see how well your auto industry survives a couple of months of that. So both sides have a fair amount of leverage. This is a game of pain thresholds. How much pain can your economy take? How much backlash can you take from the general public, from lawmakers? So we're at the very early stage of the leverage that's being applied. And you could argue that both sides have a fair amount of it. It's just who can withstand it the longest.
All right, very good. Brendan Murray, Global Trade Editor for Bloomberg News, joining us from London, where those talks are taking place between the Chinese and the American trade delegations. And again, it just feels like if they're having dialogue, that's a good thing to me. I don't think anything, necessarily bad can happen. You got to keep talking and kind of pushing the ball down the road, I guess.
Well, that's my question, too, is like, what's going to be good news for the market? Do you just need no bad news?
I think that might be it.
Or do you start to need some trade deals where the ink is signed, not necessarily with China, but with somebody kind of lets go?
Yeah, I don't know. We'll see.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
In D.C., there's still stuff going on as well. Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joins us now. Nathan, obviously the headline over the weekend is the riots in L.A. and then the National Guard being sent in without the governor having asked for it. How is that unfurling in D.C. right now?
So I would say, it was one of those things where President Trump wanted this fight because it plays to one of his key messages that won him the election, and that was on immigration. But, in terms of how it plays in terms of things like the One Big Beautiful Bill or to tariffs or to the, that's really not happening just yet. There was a lot of discussions about Medicaid cuts and SNAP reductions and Inflation Reduction Acts. And those messages are very difficult for Republicans, but they're still moving forward. So when it comes to Los Angeles and this idea of troops, I think President Trump certainly wants that to try and deflect some of that message away from Medicaid cuts, for example. The question is, we anticipate the One Big Beautiful Bill going into July. Will California go into July? Time will only tell.
So where are we on either, cuts to expenses like Medicaid or new revenue like taxes? Where are we in that discussion these days?
Yeah, so, there's really three things that came out of the House bill. It's the Medicaid, it's the SNAP benefits, and it's the Inflation Reduction Act. Now, each one of those was given a certain time frame of when those tax credits, and in the Medicaid cuts, an example of when they would actually take into effect. Now, the House conservatives insisted for Medicaid, for example, that it would start in December 2026, the Inflation Reduction Act 2028. All this being said. Now, what the Senate is doing at the moment is looking how to moderate it. And so Senator John Thune gave a statement just last week saying that we're going to anticipate a lot of that pushing back. So what we're telling our clients is that go back to the original House and Ways and Means text, where for a lot of these tax cuts and a lot of these tax extensions, they would start taking place in like 2028 or 2029 beyond Trump's rest of his administration. That's where we think the Senate goes. Now, when it comes to Medicaid in particular, obviously it's a very difficult vote for a lot of Republicans that have either constituencies or states that are heavily development or heavily reliant on Medicaid. We think that most likely that those ultimate decisions, if you will, are going to be votes to kick the can and push those cuts off so that if a future president wants to come back and revisit it, that person would have flexibility.
Right. Interesting. In terms of the feud between Elon Musk and President Trump, I guess it's a twofer. Like, one, where are we with that? But then more importantly, kind of what is Doge doing within the government without Elon Musk?
So it seems like we're sort of at a truce at the moment. Now, I say that, obviously, it could change almost instantly. But in terms of where we are with that, the White House sent what is known as a rescissions package, trying to codify around $9 billion in cuts. Now, this is mostly USAID, state, and NPR. We looked at it from an investment point of view, and we actually don't think there's much there market moving. But the reason why it's important to talk about is that this is the first of many rescissions packages that will come probably throughout the rest of this year. Now, the White House can essentially say, look, Doge has identified these $1 billion number of cuts. Now we need Congress to go in there and actually approve this. Now, you don't need a filibuster. It's just a majority vote in the House, a majority vote in the Senate. But obviously, there are differences between what Doge wants to do and what senators want to do. This happened one time in 2018, and the Republicans just said, look, I can't vote to cut these things that are ultimately going to impact my district. So we are going to continue to see things like clean energy, tax credits, loans, grants, and so forth like that. Those rescissions packages are most likely coming later this year.
Last week, Alix and I were broadcasting remotely from Washington, D.C. area. And one afternoon, I was walking around town, walking past the Department of Agriculture, which is a massive building taking up like a whole square block. And it was quitting time, and people were coming out by the thousands. It goes back to, we don't know what these people do, but I'm sure they're doing good work. But now that Elon Musk is out of the picture, is Doge still a thing? Are people just going to come back into the federal workforce now?
Well, anecdotally, I would say yes, Doge is still a thing. Just talking to my friends and family around the region, they certainly are still active. And there are Doge employees at pretty much all of these agencies. But I would say is that rather than being the bully pulpit of Elon Musk, now each agency leader is the one that actually has to make that decision. For example, over at the Federal Reserve, Doge isn't there yet, or as much as I can tell, they're not there yet. But Fed Vice Chair for Supervision, if you look at Michelle Bowman of her speech for last week, it had a lot of Doge elements to it in terms of saying, look, we need to get cut, we need to actually become more streamlined and so forth like that. So the idea of Doge is certainly going through the agencies, but the bully pulpit of Elon Musk isn't there, so you will see cuts and you will see streamlining efforts continuing throughout the rest of this year.
All right, Nathan, thanks a lot. Super appreciate Nathan Dean, Bloomberg Intelligence Senior Policy Analyst, joining us from Washington, D.C.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. The split up that's not a surprise at all for anyone on Wall Street is Warner Brothers Discovery splitting into two publicly traded companies, one with HBO Max film and TV business, the other with its cable business. The stock is up over 7%. And for more, Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media, is with us. Geetha, do we like this plan? What in it was it all surprising?
We like the plan, Alix. This has been many months in the making. So last December, they had actually reorganized the existing business into these two separate units, the TV business and then the streaming and the studio business, kind of eventually paving the way for exactly the announcement today. I think the surprising part, and this is a little bit of a pleasant surprise for Warner Brothers Discovery, has really been on the debt side. So as you well know, the linear TV business is challenged, but the bigger problem for WBD has really been a huge amount of debt. And this debt was really as part of the combination of Warner Brothers and Discovery, which happened a few years ago. At that point, the company had over $55 billion in debt. They've paid about $19 billion down, but they still have $35 billion. But what they're doing now as part of this transaction is they have a tender offer out there. They're really kind of looking to streamline the capital structure. So when you have these two new public companies, there's going to be a much more manageable debt load at both of those companies. And I think investors are really reacting positively to that news.
Geetha, when they put the companies together, one of the arguments was to create scale to compete against Netflix and Disney. What happened to that argument?
Yeah, exactly, Paul. Yes, they did create scale as far as the TV networks part of the business was concerned. You have Discovery, which is really the leader when it comes to nonfiction. You have, the Warner networks and HBO, which is the leader when it comes to fiction and quality dramas and scripted series. And they thought that would do well, but unfortunately, what happened is, and all media companies, as you well know, Paul, have this conundrum because they have the TV business, which brings in a lot of the cash, but is literally a no growth business. In fact, it is in decline. Both advertising as well as affiliate fees are in decline. But then you had the streaming business, which initially kind of had a little bit of trouble because, in that whole game of subscribers and that land grab for subscribers, they actually ended up incurring a huge amount of losses. But there is this whole wave of content cost rationalization. We've seen a turnaround in all of the streaming businesses, and Warner Brothers Discovery actually has kind of led the charge there. So they were actually the first to get profitable in terms of streaming. And so now we're seeing this huge disconnect, or at least they are saying that there is this huge disconnect between the TV networks business and the streaming, the studios business, which should arguably get a much higher multiple. Mm-hmm. And that's kind of the reason for this split. So we're seeing now multiple companies do this actually. So Comcast, which has the NBC division, they're splitting off their cable networks. We had Lionsgate and Starz, where you have Lionsgate as a independent movie studio, Starz as the media networks, and now you have Warner Brothers Discovery. So there's this whole big movement now towards, this vertical kind of separation, if you will.
I mean, do they all come together then and create kind of one less great TV network thing?
Yeah, that's kind of the plan. So the most logical combination, and this has been floated around for months now, is that with this news of the Comcast, the NBC cable network separation, would that become like this kind of roll-up vehicle? And that's kind of what a lot of the industry experts are thinking. They're expecting, now that you have this news today with Warner Brothers Discovery, everybody's kind of expecting down the road some combination of maybe that Warner Brothers Discovery TV assets along with the Comcast assets, and who knows who else kind of spins off their networks, and then that becomes this giant kind of TV network umbrella. Going back to Paul's point about scale, because scale really matters now in this business.
All right, how about Paramount, your other sick child in your coverage? What's going on there?
Yeah, so we really don't know what's going on there. So there's been a lot of ups and downs, Paul, with the whole closing of the deal. So the Paramount Skydance transaction, it was announced last year, sometime in July. It was supposed to close by the end of the first half of 2025. But there's just been so many different press reports. They've had to do different things to appease the current administration, to appease President Trump. I'm not sure he is yielding so easily. So it's still kind of 50-50, Paul, whether that transaction actually closes. So there's just too many things up in the air. And then again, there is the lingering question, because we know that Skydance was really only interested in the Paramount studio business. So again, what they kind of do with the TV networks business, what they do with the streaming business, that's all a huge question mark. So visibility very, very limited right now for Paramount.
I guess I just wonder, if you stick all the cable networks together, how does that actually generate real income? I mean, I know that's a cash cow to some extent, right? But then you have a lot of debt and there's no growth. So, like, what kind of asset is that?
Yeah, it's definitely a melting ice cube kind of an asset, which is exactly what, the TV networks have been. The argument that all of these media companies are making, Alex, is that somehow by kind of banding together, because each one of them will have one or two networks that is kind of a must-have network. So if you're looking at Warner, you have CNN. If you're looking at if you're looking at the NBC networks, you have USA, you have MSNBC. So there are definitely always going to be some must-have networks in each portfolio, and kind of putting them all together will stem that rate of decline, or at least that is the argument that they're making. But again, we've seen that cord cutting has actually been far worse than what it was initially projected. So again, it remains to be seen. But the idea is they want to milk it till it kind of runs dry.
Geetha, do we have any early feedback from Orlando with the new Universal Park? John Tucker's asking.
It's supposed to be awesome, I think, right?
It is awesome. And we, the initial, so this actually only opened about 10 to 15 days ago, Paul. And so far, everything seems to be going in the right direction for Epic Universe and for Comcast. And we know that they are really kind of doubling down on their parks business. They actually have a new park coming out just out of London, and they have all these other attractions that are opening in the US as well. But so far from Orlando, the signs are pretty strong. So
my daughter's 10.
Okay.
She's never once asked to go to Disney, and she has asked to go to this thing.
Really?
Yes.
See, it's interesting, isn't it?
Yeah.
But now you're gonna go to Orlando. You go to the Universal thing, and you say, since we're here, let's do a couple of days at Disney World, and that's kind of the plan there.
Right.
So,
no, we're not doing either of those things.
Okay.
I'm just saying more just on like the buzz for the actual kids. You're going to make their parents do that. Go figure. All right, Geetha, always good to catch up. Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, Alix Steele, Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through a lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. So the S&P is trading at 6,008. Now what? Ann Berry is founding and managing partner at Threadneedle, joins us now. And the question I was asking before break is, do we need actual good news for a sustained move higher to all-time highs, or is it less bad news going to be enough?
Unfortunately, it feels like less bad news is going to be enough, Alex. And I continue to be perplexed as to how the market level can be higher today than it was before we started down this Liberation Day tariff regime. So I think the market sentiment is such, like, don't shock us with something terrible and we're just going to keep on humming on up. That's how it feels at the moment.
Technology, Ann, give us your thoughts on just the tech sector in general. Is that still a leading sector for this market overall?
So I think tech has been extremely highly valued for sort of 2 years at this point. But what's been really interesting to me about this earnings season is a lot of these businesses, those that have been giving out increased guidance, have been rewarded with increased investor support. And I think there are some areas of tech that continue to be interesting. A lot of these software companies that are becoming one-stop shop for enterprises, both large and small. So it does feel like there are certain pockets of opportunity, but I do think that the market's becoming slightly more disciplined around which are providing more guidance towards the upside and not hiding behind this, macro uncertainty narrative.
Well, to that point, does the macro uncertainty still touch these specific areas of tech?
Well, I'll sort of answer that, Alex, from two different perspectives. And one is from the actual client perspective, the customer perspective. And so when I think about the boardrooms that I'm sitting in, the conversation we're having is, whether we're manufacturing businesses or consumer businesses, we are concerned about the macro outlook, despite what I think is a euphoric equity market. And as a result, when it comes to hiring decisions, when it comes to CapEx, capital expenditure decisions, we're being more thoughtful and more conservative. But the one space that is still getting allocation of dollars is productivity enhancing software. And so places like Intuit that I look at, places like Salesforce that I look at, their share prices, CRM's been down, Intuit's been up, it's been rewarded for a great post-tax season. I do see spend continuing to go there. And it's about sort of sorting through to try and find the places where valuation looks reasonable.
And what's the state of play of AI? I mean, prior to all this tariff talk of 2025, all the market talked about, cared about, valued was AI. We've kind of stepped away from that a little bit. What's your view today about AI and maybe how investors should have exposure to it?
I'm not sure that we have stepped away from AI, but I think instead of it being this sort of novelty that's grabbed headlines, it's something that instead is woven into all the depths of the earnings narrative. So if you look back at the earnings call transcripts, the vast majority of businesses were talking about the ways in which they were currently or planning to incorporate AI into their own product development, into enhancing efficiency, into using it for marketing and for sales and to reaching out consumers. So I think it's actually now become something that's become table stakes. We've moved past AI as a headline grabber into, if it's a headline, it may be for the downside because it's a surprise to the market. So I think it's now here, and I think it's a place where we're looking more watchfully to see evidence of return on investment. And we're starting to see it. We're starting to see some businesses come out and talk about specific ways it added to the top line and to the bottom line. I think those who aren't coming out saying that are going to suffer in the second half of this year.
So the question, what do you like?
Well, there's a couple. Let's start with the US. On that theme, I do like Intuit. It was sort of a surprising one to me because I'd had in the back of my mind this bias when you looked at what had happened to H&R Block over time, that when it came to the core tax product, they do TurboTax. That was set for complete AI disruption. It was going to be fully automated, and the IRS had been talked about for 2 years now, issuing their own software. And I thought that's going to be really difficult for folks like TurboTax. They knocked it out of the park. They're on the path for 47% growth this year. And what they figured out is that, yes, the consumer, yes, the small business wants to have AI to improve the efficacy of their tax filing, get their refunds faster, but they also want human beings they pick up the phone and talk to. People are now, I think, sufficiently spooked by the pace of change and the complexity of change in the tax system that they're wanting a human being to talk to and to walk them through what it is they should be doing instead of filing themselves or relying on just technology. So to me, that marriage of human and artificial intelligence is one of the reasons I like Intuit, and there are others like it.
And thanks so much for joining us. Really appreciate it. Ann Berry, founder, managing partner, Threadneedle from New York City.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.